Dear students, we welcome you to our classes conducted by SL Account School, our YouTube channel. And today's topic is ratios. Ratios are important indicators and useful tools to interpret financial information for the benefit of various end users. Each of these ratios will have special usefulness, but we will not be discussing them in this class. But there are three common usefulness which may be relevant to all the ratios, namely comparing them with selected company or comparing them with the industrial norm or comparing the results of the company year to year. We will learn them in four classifications, namely profitability ratio, liquidity ratio, efficiency ratio, and investment ratios. Gross margin ratio will be gross profit divided by revenue or turnover into percentage. Markup is again gross profit, but this time by cost of sales into percentage. Profit margin ratio will be profit divided by the turnover into a percentage. Here, the profit can be interpreted or defined in different ways. For an example, profit can be before the interest charge or maybe after the interest charge. Return on capital employed, where net profit is divided by capital employed into a percentage. Here again, capital employed can be interpreted differently. Then the profit also will be adjusted accordingly. For an example, if the capital employed is referred to as pure equity, then all charges such as preference dividends, interest to debentures, etc. will be deducted before arriving at the profit. Next, expenses to revenue ratio into a percentage, or it can be a specific expenditure like operating expenditure. Where it is important these definitions are consistently maintained. Next is under liquidity ratio, current ratio, assets divided by current liabilities, indicating the ability of the company to repay their day-to-day liabilities. Next, liquidity ratio or acid test ratio or quick ratio, where inventory will be removed from current asset as it being the least liquid asset and comparing them with current liabilities. Next is efficiency ratio, non-current assets to turnover. It is net revenue divided by net book value of the non-current assets. Here the student should understand every time non-current asset is mentioned, it is talking about the average. Similarly, for trade receivables, trade payable, inventory, etc., average only is meant. Trade receivables to turnover, here only the credit sales will be taken into account. If the ratio is multiplied by 365 days in the year, it will become average collection period. Similarly, trade payable will refer only to credit purchases divided by turnover. In case if it is multiplied by 365 days, it will give the payment period. Rate of inventory to turnover ratio, cost of sales divided by average inventory, and if it is multiplied by 365, it will give the residence time of the inventory. Next is working capital cycle in days. Trade receivable turnover in days plus inventory turnover in days minus trade payable turnover in days, or average collection period plus inventory turnover in days minus average payment period. Next, working assets to revenue. Net working assets to revenue. Inventory plus trade receivable minus trade payable divided by turnover into a percentage. Income gearing ratio is interest expenses divided by profit before paying interest into a percentage. Gearing ratio is fixed cost capital divided by total capital, that is fixed cost capital plus open cost capital. As shown below, non-current liabilities plus preferred share capital divided by issued ordinary share capital, all reserves, non-current liabilities, preference shares, etc. The other classification of ratio is investment ratios. Students must know every time when a share is mentioned, we refer to equity shares unless otherwise it is stated. Earnings per share, net profit minus preference dividend divided by number of issued shares. Next, price earning ratio is market price per share is divided by earnings per share, which we worked previously. May indicate how many years it might take for them to recover the investment by way of dividends. Next is dividend yield ratio, dividend paid and proposed divided by market price per share. Organization will give the dividend as a percentage of issued share capital, but here we are talking about market price, which can be totally different. Dividend cover is profit available to pay dividend into the dividend actually paid. Dividend per share is similar to earnings per share. Here, instead of profit, it is the dividend. Dear students, we hope you have understood what we have learned up to now. Now let's look at some questions. Out of the four options given, which ratio measures the business average credit period? Current ratio refers to the relationship between current assets and liabilities. Is about the relationship between inventory and turnover. Acid test ratio is current assets minus inventory compared with the current liabilities. Therefore, the answer D, which refers to the average receivables over turnover, giving the payment period or credit period. The next MCQ, perusing the information given, you are required to calculate the number of days you take in order to pay your suppliers. Out of the information for the answer, credit sales not relevant, total purchases not relevant, total sales not relevant, trade receivable not relevant. If you note the working, 40 divided by 320 into 365 days, roughly 46 days, the answer is B. Next MCQ is about current ratio and acid test ratio, how this can be improved. Option A and B will reduce the potentiality of debt collection and will not help. C is about inventory purchased on credit, therefore the acid test ratio will become even tighter. Therefore, the answer is D, where cash is brought from outside the current assets operation. The next question, a set of information given. Three different questions are given. Question 1, working capital, that is current assets minus current liabilities. Question 2, current ratio, that is the relationship between current assets and current liabilities. Quick ratio, current assets minus inventory compared with current liabilities. Please look at the working capital is 66,000. Therefore, the answer is B. Please look at the working 2, ratio between current assets and current liability. 2.1 is to 1. The answer C. is look at the working 3, where inventory is not taken into account, leaving a balance of 46,000 on the asset side, which is 0.7 of 60,000. Therefore, the answer is A. Next question is, in most recent years, a company had a sales all on credit 830,000, cost of goods sold 525, opening and closing debtors and inventory balances are given. 4 questions are given. We have given the answers with the working along with the questions. Question 1. The inventory turnover ratio. 3 options are given. Formula is cost of sales minus average inventory, that is 525 cost of sales divided by 100 plus 110 divided by 2 is 105. Therefore, the answer is 5. B. The second question is the accounts receivable turnover ratio for the year. 3 options are given. Formula is credit sales divided by average receivables, that is 830 divided by 80 plus 86 divided into 2 is 83. Therefore, the answer is 10. C. Question number 3 is how many days of sales were in account receivable? You see the previous answer, it gives how many times it turned over, 10. Therefore, if you divide 365 by 10, the answer is found, which is 37, option B. Question number 4 is how many days of sales were in inventory? Inventory turnover ratio, as answered in the question 1, is 5. Therefore, if you divide 365 by 5, the answer is found, which is 73. The answer is C. Okay, now let's move on to the next question. Extracts of profit and loss account for 2 periods are given here. 1 is gross profit to turnover. Sales 250, cost of sales 150. Therefore, 100 is gross profit divided by turnover of 250. As a percentage, it is 40%. In the same way, for the next period, it is 35%. Next question, net profit 20 divided by the turnover into a percentage is 8%. Same way for the next year is 10%. In the next question, extract of balance sheets for 2 periods are given. Return on capital employed, 20 is the profit divided by the average capital employed. Opening capital of 150, closing capital of 160, giving an average capital of 155.9% for the first period and 23.5% for the subsequent period. Current ratio is between current assets and current liability, that is 120:6. Therefore, the answer is 2:1 for the first period, 1.3:1 for the subsequent period. Asset test ratio, current assets minus inventory, which is 60:60, 1:1. For the next period, 195 minus 105, giving a 90 balance, which is 0.6:1. Okay, the final question is about investments ratios. Some share capital details are given here. Ordinary share of 80,000, preference share of 20,000 at 5%, operating profit of 21,000, market price 4, dividend proposed is 10 cents per share. Question 1 is earnings per share. Shares always refer to equity share. Therefore, preference dividend of 1,000 is removed from the operating profit of 21,000, leaving a balance of 20. As against 80, it is 25 cents per pound. The next question is price earning share. at the rate of 25 pence per share for the investment of £4, it will take 16 years. Next question is dividend yield, that is dividend proposed in terms of market value of the share is 2.5%. Even though as per par value it is 10%, as per market value it is only 2.5%. Dividend cover indicates the profit available, which is 20 divided by the dividend proposed 8 is covered 2.5 times. Hope the students have understood. We recommend more and more exercises like this in order to get a better familiarization of the subject. Dear students, as you all know, these classes are provided to you by our YouTube channel, SL Account School. We kindly request you to subscribe, like, share, promote it among those who are interested. Thank you.